I want to turn our focus, Scarlet, back to Europe for a moment because our next guest says he knows exactly where things on the continent are headed. A breakup, and he says it'll get there much faster than most people think. Stanley Crouch is Chief Investment Officer at Aegis Capital, where he helps to oversee $2 billion in assets. Now, Stanley, I'm not talking about Europe as a whole, but we're talking about the European Currency Union. When you say breakup is much closer than most people think, what kind of a time horizon have you got in mind?
I think a matter of months.
Months.
And it's a recalibration, let's call it that. And I think if they're smart, they've already planned for this contingency because we've got an impasse, and now it's showing up in the political. It's a tale of two Hollands, Monsieur Hollande and Holland. Holland's government fell, and Monsieur Hollande looks like he's probably going to win. And he's,
in France?
Yes, in France. And he's rejected a lot of components of the fiscal union. Now, if we take it back to Ms. Merkel, she's losing her best ally in Mr. Sarkozy, should he lose. And Holland was the most aligned with the quote-unquote fiscal rectitude. So that's a big problem. Now, Ms. Merkel just Saturday in an interview said she's not budging.
Yeah, but what proof do you have that they would actually abandon the currency project? The euro right now is trading at 132. It's significantly higher than its lifetime average. If everyone thought the euro was going to fail, wouldn't they sell it?
Not necessarily, because it's formulaic. It combines everybody in the current construct. What I'm saying is it's not like there's going to be some hugely disorderly breakup. I think there's going to be a very orderly transition to a new euro. Call it Euro 1A, possibly led by Germany. Because, look, she cannot sell any difference in what she's already sown domestically. If she sees people in the photo op at the summit and the December summit X'd out of the picture, and she's running next year, I think she's in a real tough spot. And so the people in Europe are deciding the outcome. If you fall one after the other, that's going to change the whole construct. And they're rejecting this austerity. And, you know, you talk about Germany being fiscally prudent. They've got a higher debt to GDP ratio than Spain. So, you know, people need to know the math is on the side of my opinion, which is only an opinion, but it's an aggregate math problem, and it's not sustainable.
Okay, so let's go along this line of a euro breakup. How would it transpire?
I think it would be announced as a fait accompli, not to keep using French terms, but the point is that it would be very structured. It would be semi-orderly. Look, Greece is having an election as well. The radical fringe parties are gaining more and more on both the right and the left. If they don't continue with the deal that was worked out with their debt, you know, it all breaks loose then, too. So there's so many ways this can come apart. I think they'll understand this at the core and start to say, okay, let's go to plan 1A.
But nobody is saying that out loud.
They're not, but that's what always happens, isn't it? And surprises.
So let's go back to the point that Sara made a couple of minutes ago, Stanley, that the euro trading at $1.32 isn't really reflecting concerns that it's about to lose a tremendous amount of value. So if people subscribe to your theory, if they believe that a breakup is, if not imminent, not all that far away, how do you invest? Do you sell European stocks? Do you short the euro? What do you do?
Look, there's good value there. There's some cheap things. Greece is on sale. Spain may be on sale. There are people like Mark Mobius that are starting to look into some of those things. I think you've got to go back to really thinking about going forward and sustainability. That's what it is for us. So, you know, we use a core income model, and then we use an asset allocation model based on what we see. Look, last time I was here, we were 50% in cash. We're much less in cash because we saw a bottom. We saw a proven bottom in the S&P here. We started to allocate more. We also allocated more to metals very recently as metals seem to have found a bottom. So we're getting these.
But did you allocate more to Europe?
No. Because we don't participate directly. We use models that are strictly domestic, but there's so much exposure to U.S. multinationals in Europe, it's a proxy.
So it may be winning, may be less a matter of taking a view on Europe and more about taking a view on American financial market?
And the macro world economy. You know, China's slowing. We have a problem, too. Look at GDP just came, right, last week. It was pretty disappointing relative.
Capping off a couple of weeks of disappointing data.
Yeah,
So
but
you're
the
pretty
markets
bearish.
were strong.
You're bearish on U.S. stocks.
No, I think we're going to have a much higher high this year, but we're also going to have significant lows because the sentiment is going to shift to much more volatility. We've already seen that. You know, the slow meandering rise that we had in the first quarter gave way to already some significant volatility, and we don't look at it in a linear fashion. You know, most analysts come out and say, we think the S&P will be up 8% this year. So if it hits 11%, you know, right away, they say, let me ratchet that up, and they look at it in a linear way. We think, no, you've got to look at it at how it really trades, which is a lot of volatility.
But your tactical call right now is to be positioned for a higher high.
Yes, we think we're going to see significantly higher highs than where we are right now.
Over what period of time?
Few months.
A few months. So
yeah.
you want to see the S&P 500 hit what before you decide to pare back your positions again?
Well, it depends on how it pulls back. Not so much what it hits. We've, you know, got some targets in mind, but it's how it pulls back. Does it pull back very impulsively, or does it pull back correctively and maintain support levels? That's the key. Because then you can make new.
But you think the U.S. stock market can hit higher highs over the next few months as we see, in your base case, a breakup of the second most widely traded and held currency in the world?
Sure. How's that? You know, how's the situation in the Eurozone doing now? You know, everybody knows that Spain has a recession.
But it's an important question, because what Sara wants to know is if Europe falls apart, is it going to drag the rest of the world with it? And you don't think so?
No, because I think it's going to be a semi-orderly breakup, and in a formulaic way. Everything is rooted in math.
In effect, it's already priced in.
It's priced in, yes. And so when they do what they do, because look, the political construct is Monsieur Hollande, he can leave the euro with France. He can just say, we're done. We're issuing the franc. Now, I don't think that's going to happen in a disorderly way. I think it's going to happen in a semi-orderly way. That's all. And I'm not the only one that thinks that.
You certainly are not. Stanley, great to see you this morning, and thank you for coming.
You too.
He is not the only person calling for a breakup of the euro, but I wouldn't yet call it a majority opinion. Stanley Crouch of Aegis Capital here on the Inside Track.